On this episode of After Earnings, Shift4, the payments company that aims to deliver technology beyond the terminal, integrating into restaurants, hotels, sports arenas, and a host of other destinations for in-person experiences. In fact, most of us have probably used a Shift4 product without knowing it. I'm joined by Shift4's Chief Executive Officer, Taylor Lauber. We discuss the company's global expansion strategy, travel disruption as one risk to the business, how Shift4 utilizes AI to analyze its treasure trove of proprietary data, and the broader post-pandemic pressure on payments sector stocks. Let's get into it. Taylor, thank you for joining us live from Pennsylvania from HQ. You know, as I was digging into reading about Shift4 in preparation for this conversation, I cover a lot of experiential names. I invest in them. I've operated a couple. And I feel as though Shift4 is sort of a name in the space that folks aren't as familiar with because you sort of straddle the worlds of payments and fintech on the one hand, and on the other hand, the world of hospitality. Clarify this for us if you don't mind, Taylor. Break down, give us some stories around the specifics of what your products do in these fields.
Yeah, sure. So I'll give you a little bit of the history because I think the history dictates kind of why we are where we are. And at times throughout that history, we've kind of been very like almost too product oriented in our narrative, and not what makes us special in a world where there's lots of different fintech products for lots of different verticals. The business started as what our founder likes to call a generic practitioner of payments. We would give payment terminals to small businesses that were accepting electronic payments probably for the first time. This is, the late 90s. And during that, it was an incredibly successful time. This was a gold rush. This idea that transactions are moving from physical to electronic is something that I don't even think was as well appreciated by those who were pioneering this industry, just how much societal wind was behind them. Keep in mind, as teenagers, we're getting sent credit cards to us in the mail, and yet a business is not sure how to accept them. Like that wave of consumer behavior was incredibly beneficial to these early entries in the payments market. But our founder has always been the type that success breeds paranoia. Like, was it luck? How do I do this again? How do I prove that I can run a durable business for 20, 30, 50 years, not just the few years in a successful growing industry? And so it compelled us to embrace products very quickly. Payments as a service can feel a lot like an electricity bill. You don't think about it when it's working, you complain when you get your bill, and then when it doesn't work, it's really, really devastating to your business. And so by embracing technologies, we're actually able to have very different conversations with merchants. Hey, this helps you run your business better. It's no longer a utility that you need. It's something that can actually make your life easier, drive more business, et cetera. Our first big kind of product offering, actually, which is what put us into this experience economy, was ironically a defensive move. It was in the mid 2000s when e-commerce was just coming about. Now, I wasn't at the business at the time, but I recall Jared telling me, I'm pretty nervous about this new company called Amazon and what it could do to all of my merchants. And I think we should start to focus on verticals that are really hard to disintermediate with e-commerce. And that put us into restaurants in the early days.
And
Pretty
specifically
obvious.
doing what for restaurants, Taylor?
The whole suite of their commerce. So everything from the terminal behind the bar that they would use to key in your order,
Yeah.
to printing the receipt in the kitchen, to instructing them how to make it, to accepting your payment at the end of the day. But also all of that is now tied into an analytics platform.
Mm-hmm.
And this was innovative. I mean, this was three cottage industries of software, hardware, and payments suddenly bundled. And it really appealed to small businesses where the alternative was $20, $40, $50,000 worth of professional services and equipment now delivered in a bundled solution. And by the way, the economics can work because we are aligned to you. You make money through your revenue, and we get a piece of that revenue as a result of participating. It was the early days, and it really transformed what was a clever go-to-market company with a relatively simplistic product into, now you're a software company. In some ways, you're a manufacturing company because you got to bundle all these solutions together.
Mm-hmm.
And the problems that we were solving were no longer, I'm out of receipt paper or how do I run a refund? It was like, how do I change the price of buffalo wings because the Super Bowl is coming up and I want to make sure that the technologies can accommodate that. Provisioning hardware, buying, procuring hardware. It was about a 15-year journey just on that product alone, but it made us experts in the physical payment experience and how hospitality operators need it to work. Back then, our typical customer, I like to say, was like an owner operated bar and grill in Boise, Idaho. Even in the early days of the company's history, as a result of this great payments distribution Jared had built up, we had customers using our new restaurant product in the most northern cities in Alaska and the most southern cities in Florida. So we had this awesome distribution network that now had a real point of difference. They're actually delivering technology to a business as opposed to a handheld terminal. Uh, we were able to identify that companies that struggled to make that evolution, we could help with. And that kind of began a little bit of an M&A strategy inside the company that if you're just the software company, we can help. Um,
So
in
roll
terms of
forward
the
to today, Taylor. As we stand right now, what is the composition of your business? Which verticals, do you serve, and what is the split between them?
So we serve restaurants, hotels, sports and entertainment, which would be both stadiums and theme parks, and luxury retail. And there's a lot of tangents that go off of that, but I'll say we're in about a third of the restaurants in the United States, mostly table service. We are in roughly 40% of the hotels in the United States with payment technologies. We're in probably 75% of the stadiums in every league in the United States with some form of technology. And then increasingly luxury retail, which the common thread through all these things, why from one to the other, is it's an in-person experience, and it's a high demand consumer experience where the operators of these franchises really want their guests, their shoppers, their patrons to have, or their fans to have, an excellent experience. And that's, to your point, what is the experience economy for us? It's this physical in-person event, and a hotel doesn't feel very different than a restaurant, than purchasing something at a stadium when you look at it through that lens.
And talk about the breakdown of your business, your top line, by region, by geography.
Yeah, so 28-year-old business, and up until about 2.5 years ago, the entirety of our revenue was based in North America and the United States. So nowadays, it's a little bit different. We've got maybe 35% coming from outside the United States, largely as a result of acquisitions and then our ability to add customers in those geographies and the products that I talked about. Interestingly, our employee base is kind of the inverse of that. We've got about 2/3 of our employees outside the United States. So that should tell you that we identify the rest of the world as a really interesting growth market. The rest of the world is still using that disconnected payment terminal from the mid 2000s that we solved in the United States. And that's what's so interesting for us, is being able to bring these technologies, which are highly innovative, to markets that haven't seen them yet.
Let's talk about who you compete with, because you've got deep penetration, as you just described, in these different verticals. But you do have some individual competitors who are getting aggressive. Toast is one, for example, that's going hard at the restaurant industry. You've got other point of sales businesses that do have the sort of razor blade of hardware and software in other parts of hospitality. How are you going to market? Is this through a direct sales team? Is this a lot of digital customer acquisition? Talk about how you're actually getting eyeballs to recognize Shift4 as the place to go for these solutions.
Yeah, sure. We've got a really extensive sales force that spans partners who are selling our product. They might be delivering our restaurant product in a particular geography, and they're configuring it. They are the face of our brand to the merchant. We have a direct sales force as well, where we're maintaining the relationship with the customer. We also have about 2,000 software suites integrated to our platform. Now, that's a lot of jargon, but that is to say, walk through like the Wynn Casino Resort or Yankee Stadium. Not every piece of software you might interact with as a consumer is something we own. You're going to go to the spa, the golf course, the parking garage. In some of these environments, there's 70, 80 different pieces of software in one building that you can pay at. We're integrated to all of that. And those software partners become an awesome distribution channel for us, where they say, I'm integrated to Shift4 because I make this great spa software that's at the Wynn's beautiful spa, but I also sell it on Main Street and I can introduce Shift4 as the payment solution. And if it's worked in this environment, I can trust they're going to do well for me on Main Street. I will say, in terms of the competitive environment, single vertical software is always the most competitive. So ironically, our oldest business, right, the
Right.
restaurant vertical
Yeah.
that I talked about, it's always been a competitive industry. That doesn't scare us. There's always been a great company out there. In the early days, it was Micros, and then NCR had a turn, and then Touch Bistro had a turn, and then Revel had a turn, and now Toast has their turn. And this is not to diminish those companies. I think Toast is an amazing company, but single vertical software, you're right to have an eye towards, hey, that's a competitive market. Our edge is our experience. We've been doing it for 25 years, and we've grown the restaurant vertical every single year for 25 years, and we've got the rest of the world to conquer. I can bore you with a lot of the minor strategic differences and how we go to market versus some of the other companies, but take that restaurant and now put it inside of a hotel, and suddenly the competitive air is much thinner, which is, it's got to work with one of the few platforms that can connect all that software in the way I described, or put it inside of Yankee Stadium. And we're kind of the only game in town in that regard. So we try to put ourselves in markets that require more than one piece of software. That's been the kind of the deliberate strategic march. But we are by no means non-competitive in, our most established vertical of restaurants.
With a team of banking experts specializing in your industry, KeyBank is always ready to take your call. And what's better? They relish a good challenge, a business challenge, a complex challenge, the kind that seems to change all the time, the kind that's so nuanced no one else could possibly understand. In fact, KeyBank says bring it on. And they go even further by staying ahead of trends. KeyBank has answers before you even know you need them. Business challenge accepted. Learn more at key.com/B2B. That's key.com/B2B. Taylor, you just said you've got the rest of the world to conquer. And from an investor perspective, the fact that you now have 35% of your business coming from overseas typically would work in a stock's favor, right? You got diversification. In your recent earnings report, you did lower your full year guidance. That was in response to the tensions in the Middle East and the impact that that's having on the European market. Hone in for us into that 35% of your business that's international. What's the split by region? Break down the impact of the Middle East, and what have the learnings been from this period about where you think about the strategic growth areas geographically should be next?
It's a great question. What I'll start with is what you described as a very specific event that impacts our tax-free shopping business specifically. And that is to say, these are wealthy travelers who travel around the world, and they buy what are mostly luxury goods, and they have the ability to get the tax back to the extent that they leave the country with the goods. It's a business we acquired last year. It's a phenomenal business. They do this for about 75% of the luxury retailers in the world. So they've got incredible market share. However, the risk to the business almost singularly is travel disruption. Mm-hmm. Keep in mind, this is a consumer base that is not heavily linked to the broader economic condition. This is not somebody who might spend a little bit less at the mall when gas prices are higher. They are flying to Paris to buy a $10,000 handbag. So it's a shopper base that's pretty well insulated economically. But if travel is disrupted, they simply won't, engage with the product. And the conflict in the Middle East has been, first of all, it's a lot of turmoil and it's a lot of hardship, and that's kind of where our minds go first. But the byproduct of that is that you've got a significant portion of the wealthy shopper base who is not traveling during this time. For us, having studied the business for a very long period of time, this is always a temporary thing. And this is a consumer base that generally, when travel disruption is abated, they travel very quickly and they spend, what they would have anyway. So it's not something that we view as a long-term issue, but it is a disruption to the business. It is something that we weathered a healthy portion of it throughout the first half of the year. We talked about in our call Q2 having about a $20 million impact that was, we were able to absorb. But Q3 is the heaviest quarter for that business. And so we did lower our guidance in reflection of kind of the impact of that, as well as just the FX rates and how they change or reported. So all this to say, any other aspect of our business internationally is actually doing quite well. We saw an increase in what U.S. travelers were spending in the tax-free shopping segment. So things are generally going quite great, but we do want people to understand and acknowledge that these travel disruptions can have an impact on the business.
And so, what has this helped you think through or provided insight into when you think about other geographic expansion plans? Do you have an M&A strategy to continue to build out that 35% as a share of your revenue? Are there other regions that you want to penetrate and perhaps now think you won't or don't want to with the same appetite, or others where you look at and say that's where you want to double down and grow more quickly?
No, I think the Global Blue acquisition in particular reinforced a theme we've been working on for about 8 years in the business, which is that the payments markets look a lot like the United States did 20 years ago.
Hmm.
It's a bank terminal, and maybe there's a piece of software that the merchant uses. But if anyone who's had the benefit of traveling internationally has watched this game where they look at a screen and then they type in what you owe on the terminal and then they hand it over to you, it feels fine as the consumer. The reality is that's a ton of friction. Imagine the merchant now wants to go check. And imagine at the end of the day, things don't add up. Well, it's because it's very easy to, in that non integrated process, transpose a number quickly. So our technology solved that 20 years ago. And we knew that there would be this appetite. I mean, we're adding thousands of merchants throughout Europe, and we just started 2 years ago. So we have no hesitancy. And in fact, what the Global Blue acquisition did is it gave us a world class product in a new vertical, but as importantly, it gave us like a beachhead in 75 countries we weren't in before, with people, with offices, with infrastructure, and with existing customers we can add those payment services to.
Mhm.
So enthusiasm is as high as it's ever been because now we're starting to see this cross sell working. We illustrated a handful of really awesome small luxury merchants that have embraced the value prop very quickly, like within months. And from an M&A perspective, yes, if we've had an M&A strategy that's driven a lot of value inside the country, inside the one country we've been operating in, you could assume now that we're in 75 more, that that strategy can be leveraged like myriad different ways.
Well, M&A is one area of investment for you and use of your cash. Another area of investment has been around technology. Can you talk to us, Taylor, about the kinds of AI investments you've made and what specific return on investment you're targeting through what means as a result of those?
It's an awesome question. I think we're all kind of, and I don't mean our industry, I mean like anyone operating a business today is looking at this wave of tools and seeing incredible opportunity created as a result of them. What we've done specifically at Shift4 is we started with a pretty wide approach. Basically, make tools available to everyone. Think about cost second, think about like, let's develop use cases first. And we saw what we would hope to have seen, which is irrespective of the part of the business they worked in, smart people who embrace new technologies were suddenly two, three, four times as productive. And that can be simple things like our FP&A team, financial planning and analysis, giving us like 15 views when they might have only given us one or two before. Our HR team giving us awesome data around who's doing what throughout the company that wouldn't have been as easy to assemble without this. And what it taught us was yes, these technologies are as powerful and sometimes scary as people have talked about. They create immense productivity, but those not embracing those tools create a new risk for the company, which is that you can spend a lot of money on these things and not get a return. We, throughout just the first half of the year, went through a wave of broad based adoption, then a thorough governance model to make sure the people who are going to get the most value from the tools are getting almost unfettered access while others are getting thoughtful, restricted access. And the rest of the company has brought up the curve. I think the most benefit in the short term comes from just operations, from being able to understand business challenges and administer and work with your customers much more fast and efficient than you haven't previously. Add fewer people as a result of some of the automation you can build with these tools. And then in product, we tend to hold this a little closer to the vest, but it does make products just a heck of a lot easier to interface with. Imagine us that same small business owner in Boise, Idaho, just engaging with a prompt and saying, I want to change the price of this, or how does this price compare to others in the region? And, am I upselling or downselling as a result of that? So we liken it to an incredible wave of innovation. I think it is that for society, let alone for our industry. But I think challenging us to use it, challenging everyone to use these tools and to apply the appropriate governance model is what's going to make sure that we're kind of on the right edge of the curve of adoption. Which and those who don't adopt are just not going to last long, at least inside of Shift4.
I've got to imagine that the amount of data you've got that you've accumulated over time lends itself to deploying AI for product enhancements, though, Taylor, pretty strongly. I'll give one example. Earlier in this conversation, you said helping restaurants figure out the right pricing of their chicken wings during the Super Bowl.
Yep.
I've got to imagine that AI and data mining to produce the answer to that query now is a lot faster, a lot more accurate. Are you planning to use your data in proprietary ways? And if so, how would they manifest in specific product developments?
It's a great question. There's two very distinct examples where I think our data is a unique advantage. One where historically we had a problem harvesting all those data, and another where we had awesome data and now it's about telling the right narratives and
Mhm.
and finding themes that you couldn't find through kind of manual analysis. First, we always called it in our restaurant vertical, we called it the Jack and Coke problem, which is imagine how many ways a restaurant might configure a Jack Daniels and Coca-Cola cocktail
Yeah.
inside their system.
Mhm.
And you've got like a dozen or more. A single button, a Jack Daniels plus Coke, a Coke plus whiskey, etc. And when you think about how am I going to give meaningful data to either external parties or our own customers around the consumption of Jack and Coke, it was like a near impossible problem to solve. And AI solves that almost instantly. So the idea, especially in the food and beverage vertical, where operators have very distinct workflows, we can deliver a much more thoughtful kind of data analysis for them as a result of AI than we could have before that.
Mhm.
That's really, really cool. Separately, I'll talk about the tax-free shopping business again for a second. Um, this is one of the most rich data assets in the world, and I don't want to understate that. Uh, think about this basket of 90 million luxury shopping transactions where the product requires us to get passport information, to get contact information, to get payment information, and to get SKU level data. We need to know that it was this color handbag or this type of watch that was purchased in that institution so that the customs authorities can validate that the person's leaving with the good. Purchase history data is really, really hard to get at scale. It kind of lives at Amazon, it lives at Walmart, probably at Shopify. It doesn't really live anywhere else because of that SKU level data. Is important and proprietary to all these operators. We have that, and we have it for probably the most significant and wealthiest shoppers in the world. Tax-free shopping really doesn't have an upper bound. You have, billionaires like to do it. Believe it or not, billionaires don't want to pay an extra 5% or 20% in tax. So AI is going to help us with that. Global Blue already did a phenomenal job. That is our tax-free shopping business. They did a phenomenal job kind of bringing these narratives to their customers and saying, hey, here is the type of consumer you should be targeting with your goods. Because I don't just see your store's performance, I see the entire city and all your competitors, and I can help you target the types of customers you want to better. That'll be turbocharged as a result of the data that we have.
Taylor, you've got data working in your favor. You've got the repository of it, the treasure chest of it. You've got AI accelerating the pace with which you can use and monetize that data. You've got deep penetration in the end markets that you're in. You've got the promise of more global growth. You just had earnings results which had gross revenue up 34% year over year. It was a good outcome. Adjusted EBITDA was up. But your share price has suffered. It's not been a fun ride for the Shift4 stock, down about 25% year to date, 48% over the last 12 months. And one thing that seems to have rattled the market more recently was a recent debt presentation suggesting that your free cash flow forecast was coming in lower than it had been before. What's the market not getting? Why is this happening to your stock?
So It's the right question, and between employees and our founder, we own 42% of the company. So there can't be, a basket of people more aligned to wanting the right outcomes there. I do want to step back for a second and acknowledge that our industry, and I'll start with like payments, and then I'll go on to fintech as a derivative of that, has been under significant duress from an investor's point of view over the past kind of 5 years.
Because
And
why?
it starts with a very simple theme, which is the wave of physical to electronic payments was like a 25-year gold rush. And investors kind of always knew if I bet on a payments company, I would do better than GDP because they're growing faster than GDP. They're growing at consumption plus this conversion ratio. The pandemic pulled that forward. There was no longer any cash in this ecosystem. And suddenly, and we watched this on the face of many investors, the difference between a good company and a bad company within the payments industry was something that they had to understand. There's no patting yourself on the back for picking Visa versus MasterCard anymore. They both did great. Now you really need to know which of those is going to win.
Sure.
Compounded by just the sheer exuberance in capital markets funding, we called it SPAC mania. There were dozens of companies that are just features that suddenly were presenting themselves as public companies. I think there's several high profile examples of hundreds of billions of market cap being wiped out in traditional companies within our industry, competitors, et cetera. When those types of things happen, I don't even try to not acknowledge the pain inflicted on investors. Didn't have a great appreciation for how much of the investment growth was societal trends versus individual operating performance. That's scary. And I need to take a step back and just understand what the heck's going on. I think our industry is going through that. I think it will prove that AI, for some of the reasons that I just mentioned, really favors companies like ours. But when you sit down in front of a terminal and you vibe code your own software to solve a problem, it can really scare an investor when they think about how that could be applied. Our industry, and one of the things I love about it, is that we are certified from the financial institution all the way to the physical device. Individually for every single workflow we have, every version of software. AI can't replace that certification process when money and important data is flowing through the process. So I think investors will get past this. I acknowledge the skepticism of the industry. I acknowledge that when we've just done the largest M&A transaction in our history, it can be hard to kind of piece together the narrative. But we've shown a pretty awesome history of putting our heads down, doing our jobs. The fact that we are as employee owned and founder owned as we are means that we can kind of ignore some of this short-term capital markets noise and just keep doing what we're good at. So I don't want to sound dismissive because I fully appreciate the confusion and quite frankly, frustration and performance issues that payments companies in general and our own stock has had for a basket of investors. But it really hasn't changed our mentality of kind of what we're good at, and that we're going to keep doing that. And I think, this last quarter was a good proof point of that. We had a pretty meaningful amount of turmoil in the business and largely did what people expected us to.
Taylor Lauber, CEO of Shift4. Please come in person. Love to have you in studio. There's a lot going on as you continue to integrate and you continue to expand here. Would love to get the update. Thank you for joining.
Awesome. Thanks for your time.
I'm Anne Berry. Thanks for tuning into After Earnings, the show that brings you up close and personal with the executives behind the world's most interesting publicly traded companies. If you learned something today, don't forget to like, subscribe, and share with your friends. Upcoming episodes will feature CEOs and CFOs from Prudential, CuriosityStream, and many more. We'll see you next time.